So I get a lot of questions from business owners, new and existing, about how their business income is taxed. And this all depends on how your business entity is set up. And today we're talking to, I'm not sure there's a lot of you out there, but my C-Corp owners, all right? C corporations. Technically, they're just corporations, but we like to say C-Corp to distinguish from our S corporations that we talk about a lot on this channel as well. So today we are going to define what a C corporation is, how you report your taxes and your tax liability, and how much you can expect to pay when it comes to tax time. When you set up a new business and you apply for your FEIN, your tax ID number with the IRS, you have to decide if you want to be a corporation. Do you want to be identified as a corporation? That's a legal distinguishment, a legal classification. But if you do not make the election to be taxed as an S Corp, then you're going to default to being taxed as a C Corp. And that's who we're talking to today. If you watched any of my other videos, you guys, about sole props, single member LLCs, partnerships, S Corps, you know that they all have one thing in common, and that's that the income ultimately gets taxed to you at the individual level. C corporations are a totally different entity, you guys. They are completely separate. So not only do C corporations file their own tax return, known as an 1120, they also are going to pay their own taxes. So your business, you've decided to be a C corporation, you have all of your gross receipts, you subtract or deduct all of your expenses, and you're left with your taxable income. That taxable income, your company, your corporation is going to pay 21%. Flat 21% tax rate. Whether you make $1 or you make $1 million, okay? You're going to pay 21% tax on every dollar of net income. That is as of May 2021. New president does mean there could be new tax laws, so if you're watching this way down the road, double check. But if you're watching this right now or relatively soon, 21% tax bracket for C corporations. So let's use numbers. If we made $300,000 in all of our revenue and we had $200,000 in expenses, we're left with taxable income of $100,000, which at a 21% tax bracket means we're going to pay $21,000 in tax. Boom, done, simple as that. Let's talk about you as a shareholder or an owner of a C corporation. How do you get your money out of the corporation, right? We're all working, we own these businesses to make money. So as a C corporation officer, you have two ways of getting that money out of your business. The first is through W-2 wages. If you're working in the business, in the corporation, and you're doing things for the business, the business pays you a deductible W-2 salary. Easy as that. As that owner, shareholder, employee, you're going to then take that W-2 and report it on your individual tax return. That part, super simple. However, with a C Corp, a lot of times there's a ton of shareholders, all right? And C corporations pay out distributions. So this is the way for investors to get their money back on what they invested, the money they invested in, okay? So whereas you as the shareholder, as the owner, as the president may be doing work for the business, you may be the CEO or the COO, right? And you're doing work for the business and getting that W-2 wage, you may also be entitled to a piece of the profits. There may be other investors, you may have 1,000 investors and they're all entitled to a piece of those profits. So how are those profits taxed? That's where it gets a little dicey. If you've ever heard the term double taxation, this is where it comes from. So stay with me, all right? So our corporation had its income, subtracted its expenses, had its taxable income, right? And paid its tax. We're done for the year, right? Then we've said, okay, we have a ton of money left. We want to pay out distributions to all our shareholders. We then pay those distributions to each and every shareholder, and we issue them what's called a 1099 div. That's, as an individual, what you're going to receive to report on your personal tax return, all right? And then you're going to get taxed on those dividends. All right, and the thing about that, dividends paid out by a C corporation, not deductible to the business. All right, so it doesn't get to reduce that amount that's subject to that 21% tax. Okay, and that's why we're talking double taxation. Business pays 21% tax on the income. Anything that comes out to me as a shareholder, I'm then going to pay taxes on at the individual level. Keeping in mind, you guys, that distributions can be maneuvered in a way that they can get preferential tax treatment on that individual level, meaning there's a thing called long-term capital gains or qualified dividends, which are subject to a lower tax rate, maybe 15 or 20%, but you're still going to pay tax on those distributions, on those dividends. So that's where that double taxation comes into play. So in the end, what's really important to understand is if you're a C corporation, you guys, in my opinion, back it on up here for a second, in my opinion, you do not set up a C Corp without consulting with a lawyer and a tax advisor, because there is a lot that goes into being a C corporation, a lot of regulations and rules, which is totally fine and perfect for some businesses. You just want to make sure you know what you're getting into and make sure that a C corporation is the right entity set up for what you're trying to do with your business. All right. But in the end, what you're going to see is a totally separate tax return, paying its totally separate own tax, and then W-2 wages paid out to any shareholders that are doing work in the business, and dividends paid out to any and all investors who are looking for their share of those profits. And those distributions or those dividends are going to be taxed on the individual's tax return. If you guys have any questions about what we talked about today, go ahead and leave a comment below. And then I highly suggest you head on over to our Facebook community, Money, Taxes, and Finance for Small Business, because these topics are what we talk about on a regular basis and have live trainings on every week. You can access that group by clicking the link in the description box. Thanks for watching. If you found this video helpful, please give it a thumbs up, subscribe, and while you're loving on me hard, go ahead and hit the notification bell so you never miss a future video.